My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Can investing be fun? Are we allowed to enjoy buying the stocks of companies we like? Maybe after doing some homework? Now, according to this market, with the Dow gaining 23 points, S&P advancing 0.09%, Nasdaq climbing 0.62%, the answer is it can be fun. And it can be rewarding, as long as you know what you own. Now, I realize I'm going to get a ton of pushback on this one. Fun? Investing's not supposed to be fun. We're told that fun is a classic sign of a top. When people are giddy and buying everything that moves, it means that the market is peaking.
The House of Pain.
Well, it's absolutely true in the long run, but I don't think we're there yet. Now, not everything is moving. You still need to be selective with your stock picking. It's not like this is a euphoric moment. 3 weeks ago, the averages were getting crushed. We're told that the Fed could take the punch bowl away at any moment. Remember, this whole run started when Fed Chief Jay Powell indicated he's monitoring the economy and will cut interest rates if he needs to. So if he comes out this week and says the consumer economy is strong and therefore we don't need a rate cut, well, yeah, sure, that could be troubling. We're told Trump can crush us with a single tweet. Granted, it's happened before. But as we get closer to the election, I think that he'll be less and less likely to rock the stock boat, especially given the ugly run of polling he's had lately. We're told valuations have gotten insane. However, that's only true for some of the more cultish IPOs. And even some of those valuations are justifiable if everything goes the way. Best for last. We're told a recession would wipe out the entire move. Thanks, Captain Obvious. Sure, a recession would do a ton of damage, but I'm not worried about a recession because the Fed has room to cut rates. I know more tariffs are bad news for the expansion. However, at the end of the day, we're a service economy, and most service providers will be fine. Same goes for the larger retailers, although the smaller ones could indeed be hurt if the president keeps ratcheting up the tension with China. Maybe that's the cost of doing worldwide business. Put all of these worries together, and you can see why so many people are hostile to the idea that investing should ever be enjoyable. Ever since the dot-com crash, there's been a de facto ban on fun. That's right, 19 years with a ban on fun, because fun is always viewed as a prelude to disaster. Hey, you know what? When you play around and horse around that much, someone's gonna get hurt. Not necessarily. Even mentioning that the market has a bunch of fun things going for it, though, has always been the kiss of death, like a jinx. That's a major reason why people gravitate toward buying whole index funds. A whole generation has been taught that owning individual stocks is just too risky. But a new generation, the ones who were kids when Mad Money first aired 14 years ago, they seem far more inclined to invest in stocks. Now, companies are coming public that millennials know about: the eclectic Beyond Meat, the thoughtful Revolve, the playful Chewy, and the substantive Pinterest. All these have captured the fancy of millennial investors who are increasingly being drawn to no-commission trading, not to mention the cannabis stocks. Hey, look, I know Beyond Meat could meet its match at the June 20th meeting of arch rival and former part owner Tyson Foods. But so much of the stock has been sold short that I don't even know if it'll matter. Chewy's play on the subscription economy for one of the great trends of our era, the humanization of pets. Companies commissioned paintings of 40,000 pets lately. Wow, what a commitment. Ask the people who got in on that IPO. Fabulous IPO. They're having fun. At the same time, iconic household names are back in style. Procter & Gamble, Estee Lauder, PepsiCo, McDonald's, Disney, Starbucks. These are some of the most beloved companies, and they're turning into the most beloved stocks, just like they used to be for so long. Now, I know most of these are classic slowdown stocks. When they all move up together, some of the wags are going to say recession must be around the corner. However, at the moment, I think their strength has much more to do with the fact that they're well-run companies with huge buybacks, great balance sheets, good dividends, and are working. I know these household names aren't cheap. It doesn't shock me. Clorox is expensive. But when a company has a fabulous brand and it's executing consistently, Well, you have to pay up for best of breed. It's always been the case in real bull markets. Meanwhile, merger mania is back. Today, Pfizer told us that it's buying Array Pharma. Hey, by the way, that's a frequently asked stock in the lightning round. Thank heavens we've been positive. Pfizer needs a pipeline. Makes sense. Sotheby's got a nice bid today. Another household name. Auction house has often been rumored as a target. Finally, caught a suitor, billionaire Patrick Drahi, who'll take it private, giving the company a lot more flexibility to do what it says it wants to do. Hey, listen to this. Most important, on top of all that, FAANG feels like it's making a comeback. Let's go backwards in FAANG. Alphabet's got a pulse again and seeks to monetize YouTube. Netflix is finally moving after spending most of the year trading sideways in the wake of January's epic rally. Amazon's now up 25% for the year. Its stock's trying to break out, helped by the RTH, which it dominates. That's the retail ETF. And the company continues its quest for total retail world domination. And Apple's defying the trade war with China, even as the company has to navigate both China and the United States. Yet for the past couple of weeks, the stock has been on fire. And by the way, I think that Tim Cook's, you should read his commencement address. Makes a lot of young people, really. You should definitely read it. Finally, Facebook is the most interesting here, because tomorrow the company will issue a white paper about what it's going to do to help the unbanked get access to the financial system. It rallied more than 8 points in anticipation of that white paper and the idea of an international cryptocurrency with real institutional backing and blockchain. Now, I know many of you snicker whenever I say anything good at all about Facebook, and with good reason. They're not exactly the paragons of moral rectitude. But right now, there are hundreds of millions of people who don't have bank accounts all over the world, who live in countries with unstable currencies. Roughly 40% of the world lives in a country with a 10% plus inflation. Thank you, Lisa Ellis from Mothenson. Oh, Craig. Okay, it's Moffett-Nathanson. I knew it would come to me. Always does. Facebook wants to give these people access to a special kind of cryptocurrency called Libra. That's Libra. And that's backed by real players like Visa and MasterCard and PayPal. You know we like PayPal. I'm betting they'll make this service free to their 2.6 billion users as part of a genuine charm offensive designed to get the regulators off their case. Hey, you know what? Think about that. Hey, you know what? I know you guys are investigating this, but we just give 2.8 billion people bank accounts. Isn't that a nice message? Of course, they're not doing out of the goodness of the heart, but that's neither here nor there. Finally, there's a whole new class of cloud computing stocks that have caught fire here. I mean, if you were in San Francisco, even... Hey, Regina, when we were in San Francisco, didn't you feel it? Regina? Didn't you feel the joy in San Francisco of all these companies?
Yes, I did.
There you go. I needed to get a little verification of that. A little verification. Let me think about it. We all know about Workday. They're all in the... How many times have we had Adobe? Not enough. Salesforce. We had Splunk, ServiceNow, VMware. Now, though, we've got these... Facebook. Maybe Facebook one day. But get this. Well, look, it's a small TV show. We do this stuff. Get this. You know what now people are talking about when I walk around? They want to know if they can get a job at Okta. They like Zscaler, Zendesk, Coupa, dozens of other companies that help businesses make themselves more effective. Plus, there's been consolidation. Last week, Salesforce bought Tableau's software. And now people are speculating that Alphabet may need to make a move. Right down those stocks I just mentioned, they are all possible targets. What do all of these winners have in common? They're fun. They're companies you know or could learn about. You can look at the tops of buildings. You can say, Okta, I got to know more about that. And you can happily buy them into weakness if you've done the homework and you believe in the prospects. The bottom joyous line, sorry, there's a whole different mindset. This idea that investing can be fun is a throwback not to the dot-com bubble in 1999, but to the 80s and 90s. We had some incredible bull runs and no one thought it was just horrible and stupid to like stocks. As far as I'm concerned, it's not pernicious. It's not silly. It's not dangerous. It's just how things were in the old days before things got corrupted by the 1999-2000 era. And if that's the case, well, guess what? The rally could last a lot longer than most people expect. Can I go to Roger in Illinois, please, Roger?
Biggest shot to Cramer. What do you do?
Oh, thank you, man.
Jim,
thank you very much.
One of my favorite Americans of all time started a company by the name of Standard Oil. It's not around anymore, but its next of kin still are. I know you aren't a fan of oil.
Nope.
But what do you think of ExxonMobil as a long-term hold?
Long-term hold, fine, as long as you understand long-term hold. I think the millennial money managers have turned on oil as if they're fossil fuels. They're looking at countries like Norway that are banning, saying, listen, we're not going to have gasoline. And they're saying that is the future. And I am concerned that that may be the case. How about we go to Bud in Ohio? Bud!
Jim, booyah, Ski Daddy.
Hey, Bud, what's shaking?
Hey, Jim, thank you for everything you do for us. Listen, Father's Day reminded me of your story about how Chinese predatory trade practices destroyed your dad's paper industry.
They sure did.
I've lived my entire life in what some on Wall Street derisively call the Rust Belt. So I've watched it happen for decades, which is why I'm interested in companies that are reshoring jobs. But, of course, I want a good investment, too. So what do you think of Stanley Black & Decker?
Yes, they're doing reshoring. I'm proud of them. Let's bring all those jobs back. I am a believer in this theory, and I think that stock is a good one. Now, the last quarter was just okay. I think that this is a better quarter, given the fact that the weather's good. Yes, a lot of things does depend on the weather because they're in these big box hardware stores. I like your call, and I salute you for what you're doing. All right, to all the haters out there, first of all, hi, haters. But guess what? I don't think this is top behavior. Yes, there are stocks that are topping all the time. But right now, well, it's kind of joyous. Sorry. We could go higher. Oh, man, money tonight. 2019 is the year of faux meat. That's F-A-U-X. As the bid to make the best plant-based patties heats up. I'm talking to one company that can help perfect the taste. And pets aren't just for cuddling. Man's best friend can help warm your wallet, too. I'm revisiting my homemade and best in show ETF that can help make money off the trend. And the days of it's not what you know, it's who you know, hey, maybe they're coming to an end. Hallelujah! Thanks to one private company that I like a lot. It's shaking up the job market. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.